You've read all the myths surrounding dragon. China is being described as the dragon economy on earth. So no surprise, therefore, when Asian stock markets fell very sharply this week. The authorities in Beijing rattled by that massive losses from circuit breaker. So the market recovered today slightly. You heard that earlier on the program. Things are coming back. Some strong gains for the Chinese market, battered after they suspended the market circuit breaker system, set a firmer midpoint rate for the currency, the yuan, trading for the first time in 9 days. On Wednesday, the market was just 29 minutes, the shortest stock trading time in history. Shares in Asia were still on track for their biggest weekly fall in more than 4 months. But Friday's advances just early today seem to reduce some of the fears they have hit the global market with since the start of the week. Watch this.
Chinese markets have had a turbulent start to 2016. Buffeted by PBOC's lower yuan fixings against the dollar, 2 days of stock exchange suspensions, weak factory and service sector surveys and worries about looming share sales by major stakeholders once a ban on such sales expires. Japan's Nikkei shares average turned positive after the Chinese central bank set the yuan's midpoint rate higher, with the Nikkei reversing a more than 3-month low hit earlier in the morning. The Nikkei rose 0.4% to 17,835.30, recovering from 17,509.64, the lowest since October the 1st. The People's Bank of China set the midpoint rate at 6.5636 per dollar prior to market open, firmer than the previous fix of 6.5646 and firmer than the previous day's closing quote, 6.5929. South Korean shares recouped sharp early losses and edged down in wobbly trade on Friday morning after news China set yuan higher, while concerns over faltering Chinese economy and North Korea issue continued to unnerve investors. The Korea Composite Stock Price Index retreated 0.1% to 1,902.95 points, its lowest intraday level since September 8, 2015. In Hong Kong, Hang Seng Index opened up 0.8% at 20,491.88 points in the morning session. Managing Director at Parry International Trading Limited, Gavin Parry, welcomed the news of the deactivation of circuit breaker, even though the mechanism was not a new thing in Asia.
But the fact that they've removed these circuit breakers is going to, again, obviously free up the aspect of people to manage their risk profile and hopefully effectively kind of flush things out of the system. Again, for other markets in the region, it's not a new thing, but these markets are a lot more institutionally inclined, they're a lot more established, and there's a lot more education in the markets as well in relation to how they work, and a lot more tools for them to manage risk.
China has recently accelerated the depreciation of the yuan, which some economists take as an indication that Beijing realizes it cannot continue to burn through its currency reserves. Japanese Finance Minister Taro Aso said early on Friday China might find it difficult to continue supporting the yuan, given the record decline in its foreign currency reserves. In response to Aso's comments, Parry said while people are expecting a continued trend in the yuan's depreciation, he believed the People's Bank of China would not allow continued speculation on that.
So what we're kind of seeing now is maybe the sentiment of people going inverse to that and saying now we're on a depreciating trend, and the PBOC will need to couple and manage those expectations in conjunction with the capital account. And these kind of aspects are really, I think, what people are talking about offshore is how they're going to manage that. Are they going to continue to step in, use the FX reserves to basically keep that spread tighter? But ultimately it's a case we've got to remember that the PBOC is not going to allow continued speculation on sentiment of continued trends.
With the circuit breaker deactivated late on Thursday, the CSI 300 index was up 1.7% at 3,350.66 points in early trade on Friday. while the Shanghai Composite Index was up 1.5% at 3,170.66 points.
Okay, it's about 10 p.m. in China as we speak. Let's continue the currency conversation, giving you a wrap of today's market. The onshore and offshore renminbi exchange rates have been fluctuating by wide margins since trading began in 2016. Analysts say there is still space for the renminbi or the Chinese yuan to further depreciate, despite the fact that the authority, the PBOC, set a higher level for that. A forex investment analyst, Jing Song, said there's still room for an even higher exchange rate of the dollar, US dollar that is, against the yuan. That may reach nearly 6.8 parity, but very hard to surpass that level, cross that level, and reach 7. Although the difference between onshore and offshore renminbi exchange rates widened in the past 3 trading days, analysts say the yuan is actually more market-based.
The exchange rate of the US dollar against the yuan has been at about 6.8 for over 2 years, since the first half of 2010. Then the downward trend triggered the process of accelerated yuan appreciation. The exchange rate of the US dollar against the yuan has rebounded in the past 2 years, and especially since August 2015. The past 3 trading days represented a process of even faster dollar appreciation.
What I see is actually quite strong signals coming out that authorities actually want to move the currency closer towards fair value.
At about 7:20 Eastern Time in the U.S. this Friday, oil prices rebound. Global benchmark oil futures rallied more than 2% early today, following Asian shares trading higher after Beijing deactivated the much talked about circuit breaker mechanism that was blamed for aggravating equity market crashes. Chinese stocks were also boosted as the yuan currency firmed in early trade after the central bank strengthened its official rate for the first time in 9 trading days. The Brent crude has risen 56 cents to 34.31 a barrel today. As we speak, the U.S. oil is around 33.45, still on track by 0.5% after marking $32.16, a level last seen in April 2004. That's a 12-year low. On Thursday, oil prices fell below $33 a barrel to nearly 12-year low as China turmoil rattled investors.
Thursday's fall in oil price was the lowest since April 2004. Oil prices have fallen by around 70% since mid-2014, hurting oil companies and governments that rely on crude revenue. China let its yuan currency slip on Thursday, sending regional currencies and stock markets globally tumbling. The offshore yuan fell to its lowest since trading started in 2010.
For a number of years, China's been key, particularly on a global level for all commodities. Also, the same applies to oil, and that's less so in 2016, but still they are significant. So their growth in demand is about 30% of the world's growth in demand for oil. It's still really an oversupply, but we expect the market to come back into balance. With gradually increasing demand and some reducing supply. But if there's a threat to that potential increase in demand, which is what the China news is, then that may mean that the market stays oversupplied for a longer period of time, keeping prices down.
Brent fell more than 5% to a low of $32.16 a barrel before paring some of its losses. It stood down 3.4% at $33.07 a barrel at midday. U.S. crude futures hit a low of $32.10 a barrel, their lowest since late 2003, before bouncing slightly to $32.72 per barrel. Prices trimmed early losses, with violence in the Middle East and North Africa offering a measure of support for the market. Oil's rapid fall has made a prediction that Goldman Sachs made last year that crude oil could fall as low as $20 per barrel seem less outlandish than it seemed.
Although oil price could hit that level, we would not expect that to be maintained, certainly not for on a monthly average basis. So on a daily or a couple of days, yes, it could hit that level, but we don't expect that to be sustained because the impact on production would become significant very quickly. So whereas it wouldn't just be a case of people stopping drilling for oil in North America, it would mean that people who are currently producing would turn off some of that production. So there would be a much quicker reaction in terms of the oil production.
On Wednesday, U.S. government data showed a 10.6 million barrel surge in gasoline supplies, the biggest weekly build since 1993. Analysts said further builds in global inventories are possible, putting more pressure on prices. Technical analysts also said there was little to stop the pricing tumbling further, with some saying that a bear fest had begun. Worsening the oil market woes is weakening demand, especially in Asia, including China, which is seeing its lowest economic growth in a generation.
Okay, we're going to Cuba after the break. Stick around.